Hey guys, Tony Denaro here. Welcome back to the channel. Well, another one for the record books, but not in the way that we were hoping. Looking at the heat map, it was another bloodbath day following on with what happened last week. Very few green squares on the heat map. We had the Dow and the S&P down over 1%, the NASDAQ down 0.6% on our decliners versus advancers today. 4,859 stocks declining. 1,891 advancing today. Tonight, we will be doing a stock market talk live. Come have a beer with us. I hope to see you on that. I did not do a lot of live streams last week because, to be perfectly honest, I don't do a lot of trading in uncertain bearish weeks. And boy, last week sure was one. Today was another. What I'm doing in times like this is analyzing stocks, figuring out what I am going to buy next. If you didn't see one of my recent videos, a bear market is where real traders, real investors are born. If you have the patience and the emotional control to get through this, you have a long career in trading and investing ahead of you. It is unfortunate that many people are going to be washed out in this time. Enduring a bear market that lasts months or sometimes years is emotionally draining. So I will be here reminding you exactly why this is happening so that you can process it, understand it, get through your day, and we will get through this. Green days are ahead for the stock market. Nobody knows exactly when. We will be talking about that though in the coming days. We are in a global market right now that is facing fears of inflation. We got globally rising interest rates, global fears of recession, real estate starting to come under pressure, and there really is nowhere to hide right now. Normally, when we think rising interest rates, people move their money over to the financial sector, thinking that banks might be able to capitalize on that and gain some extra income through the higher interest rates. As you can see again today, no room to hide in the finance sector. Consumer non-durables is another sector that people sometimes think of as a place to move money to in a recessionary market, thinking, well, people are going to need to keep buying these goods. Even that sector today, as you can see, it was very hard to find a winner in consumer non-durables. And energy companies, which had been doing well with the run-up in oil prices, now that the global economies are starting to slow down, we're seeing that even these energy companies are struggling to have gains in a bear market, a bear week like we had last week going into this week. So let's talk about what all is going on here. Before we move into the quick data points about what is going on, I want to remind you about a central theme that we talked about here on the channel last week, that in a global recessionary market where governments around the globe are raising interest rates and trying to cool off their economies, to slow the engine of business down, it is normal for money to flow out of stocks. Now, why does that happen? Recall that the price that you see on a ticker, the stock price, is investors' expectations for that stock based on future earnings. And that when governments are actively trying to slow down their economies and raise interest rates, everyone is starting to realize and finally understand that future earnings are going to drop. Investors simply don't value these companies as much because they don't anticipate the next few quarters of earnings to be anywhere what they have been for the past 12 months. We got a couple of other factors at play as well. One consequence of the Federal Reserve raising interest rates here in the US to tame inflation and get things under control is that it attracts global money into the US dollar. And this is actually strengthening the US dollar. Not only is global money flowing into the US dollar because of those higher interest rates, people around the globe in a time of global uncertainty see the US dollar as a safer bet for the security of their money. These two things combined have been driving up the strength of the dollar relative to other currencies. Here on the 5-day chart for the euro versus the dollar, you can see the slide of the euro versus the US dollar. And man, it really hits home when we look at the 5-year chart for the euro versus the dollar. Same story with the British pound, or the sterling as we call it. 5-day chart and the 5-year chart showing the weakness of sterling versus the US dollar. Now, this might be good if you are a US consumer or business buying imports from Europe or Great Britain. Your dollar is getting you more bang for the buck Same goes if you are traveling over in Europe right now as a US citizen. However, if you are a business or a consumer in Europe, you have the opposite problem. Imports, which are usually denominated in dollars, are now more expensive, adding to the troubles that Europe is already struggling with. So why am I talking about the US dollar and the euro and the sterling? What do those have to do with anything about the stocks you want to know about here in the US? Well, like it or not, we are in a global economy, and all of these big companies that we are trading do business internationally. It's important for you to understand the dynamics of what is going on in the world so that you can understand what is happening right here in the US with your stock market. Let's move on and look at a couple of other things real quick. Cryptocurrencies are holding flat. Bitcoin at 19,000, Ethereum at 1,300, recovering from a little selling pressure in the previous days. Gold sitting at 1633, silver at 1848, oil down 76.71 for West Texas crude, Brent at 83.94. But really what I want to talk about is bonds, because this is the most crucial thing for you to understand right now. As the Federal Reserve continues to raise interest rates, the yields on US Treasuries are going up. I see right here on the chart, the 2-year yield is 4.34%, and the 10-year is almost at 4%, 3.928. To put that in perspective, look at this 1-year history on the yield of the 2-year Treasury, going from almost 0 to 4.3%. Now, if you are an institutional investor, big money on Wall Street, in a time where there is global uncertainty and you expect that the earnings of companies are going to come down and the prices of stocks are going to fall, where are you going to put your money for safety? You're probably going to move it into treasuries where the yields are increasing, where you have some stability, you have some safety, and you have increasing yields. This is what happens when the Fed raises rates in a recessionary market. This is why stock prices are going down. Money is fleeing the stock market and moving to US Treasuries. So when does the pain stop, Tony? When can we expect things to turn around? It's going to be largely dependent on the Fed. And as we already know, Jerome Powell said that they plan, until they have new information, they plan to continue to raise rates all the way well into 2023. Now, we do have some CPI and PPI data coming up in mid-October, I think the 12th and 13th. And the Fed is going to be looking at that data to help make their decision about when and how much to make the next interest rate hike. The other question is, in the US stock market, how much of all of this expectations is already baked into this recent fall that we've had in the indexes? And that is a great question. I think that we're going to have some pain, some up and down to continue to go through until mid-October, when we see the core CPI and core PPI data. And then Wall Street can kind of get a feel for what the Fed's next move might be. I think it's a fair assumption to say that a lot of the pain that institutions are expecting out of companies' earnings over the next year is getting baked in. Are we all the way there yet? Is the red days in the US stock market over? No, I think it's too early to say that right now, here at the end of September. I want to leave you with a gentle reminder, and I love all of my YouTube friends. No disrespect to anybody, but if you guys are listening to people that have been telling you that stocks are going to go up when the market crashes or interest rates go up, this is simply not how the market works. And we've been telling you here for a year that in a declining market, your stocks are going to go down to get out of margin and to get some cash put on the side, because now is the time to start looking at some great companies to buy for your future. These are where fortunes are going to be made right now. The buy decisions that you make on great companies in the coming months when some deals are going to be had. And that's what we're going to be talking about in the next couple of weeks. What companies am I looking at to take my dry powder and load up on to capitalize on when the bull market returns? Again, I don't know when that is going to be. Patience is required more than anything else, guys. I want you to get cold blooded. I want you to get emotionless. I want you to stop listening to clickbait that's telling you everything is going to moon tomorrow. The sooner you can zen the F out, the more I know that you will be here tomorrow, a month, a year from now to capitalize on what is coming next. I am Tony Denaro. I want to thank you for watching. Join us on the live stream tonight, 8 p.m. Central, 9 p.m. Eastern. Hopefully we'll have some special guests for you. I do hope to see you there. Don't forget to hit that like button on the way out if this is your first time here. Don't forget to buy and hold that subscribe button, and I will see you on the next video.
You're talking like you think you're royalty. You think that I'm afraid, but I don't break.